Okay, in Chapter 4, we're looking at the income statement, comprehensive income, and the statement of cash flows. So we're going to be going through various exercises and a problem to demonstrate these. Please try these on your own first if you could, and then go through the lecture. Or do the lecture, then try going through them, and then do the lecture again. So let's take a look at our exercise 4-1. Pandora Corporation operates several factories in the Midwest that manufacture consumer electronics. December 31st, year one, year-end trial balance contained the following income statement items. So of your typical type of income statement items, revenues, expenses, gains, losses. Calculate the company's operating income for the year. Now remember, operating income is not net income. So given that information, the operating income would start with sales revenue, of course, and then subtract your operating expenses, which include cost of goods sold, selling, general and administrative, research and development. The loss on sale of investment is not an operating loss, it is an investment loss. So it is reported on the income statement but is not subtracted to reach operating income, only operating expenses. Those expenses necessary to operate your business day in and day out are reported. Notice interest expense is not being reported as an operating expense. It is a financing expense, so it is listed separately in the other section. And then income tax expense, of course, isn't either. So our operating income would be the $9,095,000, the cost of goods sold, selling, general and administrative, research and development, operating expenses subtracted from sales revenue. So please keep that in mind. You have to be very careful and think about what are they asking you to calculate. Exercise 4-2. Now we're being asked to prepare an income statement, a single step, including earnings per share disclosures, and then a multiple step. So a single step is very straightforward. Revenues and gains are listed together, expenses and losses are listed together, and the expenses and losses are subtracted from the revenues and gains to get net income. So all the sales revenue, interest revenue, gain on sale of investments are listed first and totaled. Then all the expenses and losses are listed, cost of goods sold, selling expenses, general and administrative expenses, interest expense, and total expenses and losses. We subtract them and we get income before income taxes. They're always listed separately. Income tax expense is then subtracted from income before income taxes to get net income, $298,984. Single step, usually not done this way unless you're in a service business. Most merchandising or manufacturers do a multiple step income statement. Now before we go there, don't forget we still need to calculate earnings per share. Earnings per share, remember, is net income minus preferred dividends if the company has any. Now why do we subtract those? Well, earnings per share is calculating how much earnings was made for one share of common stock. Net income is the earnings for both common shareholders and preferred shareholders. Remember, preferred shareholders get their part of the earnings, dividends, first. So we subtract the dividends from net income just to isolate that part of net income that is promised to the common shareholders. We divide that then by the number of outstanding common shares, and we get $1.67. That is reported directly on the income statement, one of the only ratios out there that is required to be. Whether you're doing a single step income statement or a multiple step. Now the multi-step. We're going to start with our sales revenue. We then subtract the matching expense to sales revenue, cost of goods sold. Remember, sales revenue is the money we charge our customers for our product. Cost of goods sold is how much those items cost us. When we subtract the cost of goods sold, we then get gross profit, the money we made purely from selling our product. Now we start listing our operating expenses. Selling expenses. General and administrative. In this case, there aren't any other types of operating expenses. They're added together and labeled. And then total operating expenses are subtracted from gross profit to get operating income, the income the company made purely by opening and closing its doors every day. Now, if there's any other revenue or expense items, income or expense items, they're listed after operating. Interest revenue is a revenue from investing. Gains on sale of investments are essentially revenues or incoming amounts from investing. So those two revenue or income items are listed after operating income. Interest expense is an expense of financing, taking a loan out. So that's listed in the other income and expense area. Revenue and gains are positive amounts where the interest expense is a negative, so you must put brackets around it in this case. So once we net those, we get our total other income, since the revenue or gains added together are greater than the expense amount. That is then added to get income before income taxes. We then subtract our income tax expense to get net income, which will be the same amount. We find earnings per share the same exact way, net income over the common shares outstanding, and report it after net income. So this is a very basic multi-step income statement. It's called that because we prepare it in steps. We list two accounts. We subtract one account from the other to get our first calculation, gross profit. We then subtract our operating expenses to get our second calculation, operating income. We then add or subtract our other income and expense items to get income before income taxes. Then we subtract income taxes to get net income. So you keep practicing this. That's the only way you retain it. Keep taking it piece by piece, little steps. Keep practicing it until you could retain it all. And you do. Exercise 4.3. The following is a partial trial balance. We need to prepare a single step and a multi-step again. Just a different scenario. So for Tuscan, there's their revenues and expenses. Notice included will be loss on sale of investments, loss from inventory write-downs. Okay. Everything but income taxes on the single step. Subtract your income tax expense, giving you your net income. Again, did they give us information about common stock? Not on this page, but there is a 413,000 shares are outstanding. So earnings per share is 90 cents per share. Okay, so just another practice with the single step. But that isn't our focus for this chapter. The multi-step is. So let's focus on that more. Sales revenue would be our beginning. Subtract cost of goods sold again to get our first computation, gross profit. Remember, that's profit from purely selling your product. We then will list our operating expenses, which include selling, general and administrative, and loss from inventory write-down. So this is a loss not from investing or financing, but from our normal operations, from having to write down our inventory. Now, if you're not sure what that is, that's fine. In a coming chapter, we'll be going over that. Our total operating expenses, 507,703. Subtract your operating expenses from gross profit. From your gross profit, you get operating income. Now let's deal with our other items. We have interest revenue, loss on sale of investments, and interest expense. So you have to think about, where do these items originate from? Well, interest revenue is normally from an investing item. That's where you're making money from stuff just sitting there. Loss on sale of investment is when you sold an investment. So that's pretty obvious, right? And interest expense is always an expense related to financing your company. So that is why it's in the other category. It's not part of normal operations. In this case, our loss and expenses are greater than our interest revenue. So overall, the impact is negative, 29,063. So that will be subtracted from operating income to get income before income taxes. We'll then subtract our income tax amount, which was not given here. We needed to calculate that. It looks like it was probably given in the problem, right? Just they didn't rewrite it here. And then net income is 371,695. Calculate your earnings per share the same way. Earnings per share 90 cents. So you want to focus on this income statement, and this is really our first step in the multi-step income statement. We're still going to add more stuff into it, but just so you understand all the different components of it. In exercise 4.4, we're given the trial balance for Semize Corporation, a manufacturing, for the year ended December 31st. They have sales, revenue, cost of goods sold, selling and administrative expense, interest expense, and unrealized holding gain on investment securities. The trial balance does not include the accrual for income taxes. We have to calculate it using a 25% income tax rate, and there's a 1 million shares of common stock outstanding. Let's do a multiple step statement and comprehensive income statement continuously and include earnings per share. So now we're expanding on that income statement to include comprehensive income. So, multiple step, start with sales revenue, subtract cost of goods sold, gross profit is the result, subtract your operating expenses, which they put into $1 amount, selling and administrative, to get gross profit, or I'm sorry, operating income. Subtract your selling and administration from gross profit to get your operating income. Any other expense or income items must be listed. Interest expense is your only item. The assumption is the unrealized holding gains on investment securities is from an available for sale security. Unrealized holding gains and losses on investment securities from available for sale are not reported on the income statement. They are reported as other comprehensive income. So we'll subtract our interest expense to get income before taxes. Multiply that by 25%. Income tax expense is $201,000. Subtract that to get net income of $603,000. Now, other comprehensive income. Comprehensive income, the starting point is always net income. Remember, it's all changes to equity from non-owner sources. So it is not dividends and it is not contributions from the owners, but it's all other changes to equity. Net income will increase equity. It is a comprehensive income. But other items, based on the information we have for Semize, what else will affect it? This unrealized holding gain on investment securities, net of tax. Net of tax. So the tax effect on a gain is it will be taxed, right? So 88,000 times 25% will give us a $22,000 tax. We subtract that. The real gain is $66,000. So that is added to net income, the comprehensive income, all changes to equity that are non-owner, $669,000. Earnings per share is 60 cents per share. Now how do we get that? It's based on the 603,000, not the 669. It's the net income you calculate. There's 1 million shares outstanding, 603,000 divided by 1 million, 60 cents per share. Exercise 4.5. Here's an incorrect income statement. We need to create a multiple step income statement. correcting it. This is a simple, what are those, single step. All right, let's take a look. To correct it, we'll start with sales revenue, subtract cost of goods sold, gross profit, 269, 255. We'll now subtract our operating expenses, which include selling, administrative, and restructuring costs. Restructuring costs are considered an operating. This is from the company changing itself and the costs associated with it changing itself. That's considered part of operations. Interest expense is not. Interest and dividend revenue is not. Gain on sale of investments is not. So our total operating expenses are those three components added together. Subtract those from gross profit to get that operating income. So now we've just isolated how much income was purely from operations. Now we'll add income and expense items from financing and investing activities. Interest and dividends are from investing. That's money we made off of our investments. Interest expense is from us financing our business. And gain on sale is from investments. So we'll add the two positives, subtract the negatives. Overall, total other income is $88,000. That is added to get income before taxes, $145,255. 255. We'll then subtract the income tax expense of $58,339 to get $94,416. So in the end, we still get the same net income. It's just the presentation was incorrect. We needed a multiple step. And earnings per share is still 94 cents per share. Net income divided by outstanding shares of common stock. Let's look at 4.6. Parallel Company has two operating divisions, one manufacturing farm equipment and the other office supplies. Both are considered separate components as defined by GAAP. The farm equipment component had been unprofitable, and on September 1st of year one, the company adopted a plan to sell it. The actual sale was completed December 15th of year one at a price of $700,000. The book value of the asset sold was $1.2 million, resulting in a before-tax loss of $500,000 on the sale. The division incurred a before-tax operating loss of $140,000 from the beginning of the year through December 15th. Their income tax rate is 50%. Pearl's after-tax income from its continuing operations, which would be its office supplies division, is $425,000. Prepare an income statement for year one beginning with income from continuing operations. Include appropriate earnings per share, assuming 100,000 shares of common stock were outstanding throughout the year. So now we're dealing with a discontinued operation of a company. Okay, so let's see how this works out. First of all, most of the companies we've been working on, or all of them so far, they haven't been selling any component of their company. So we've never had these words, income from continuing operations. In a year when a company is selling a component, and it's usually like a whole industry, a division. For instance, they were in two major types of industries, farm and office supplies. They're selling their farm division. They're getting rid of it. Well, that's a discontinued operation. The day they decided to sell it, they say, okay, have we completed our financial statement for the year? Nope. Okay. So when was the beginning of the year? January 1. Okay, so from January 1 through the end of this year, that is considered a discontinued operation. We do not want to report anything about that with our operating income or with our normal business. So now we have this line on our income statement called income from continuing operations, and that's our starting point here, $425,000. Then the company will report its discontinued operations. Now, they have a total loss, a loss from operations of $140,000 and the $500,000 on the actual sale. So $640,000 loss. But we just don't subtract that and move on. When there's a loss on an income statement or a loss, we must compute the tax savings from that loss. So the loss on the sale of the assets and the loss on operations make up our 640. 50% of that we will get back as a tax benefit because we'll take that loss on our tax return. We'll actually pay $320,000 less in taxes because of that loss. So what's the real loss here? The real loss on discontinued operations is $320,000. The actual loss plus the tax savings. So, okay, there we go. We'll now subtract the loss on the discontinued operation from the income from the continuing operation to get our net income. Now we didn't have to do anything with income tax on the 425 because it said it was after tax income. It's already been subtracted out. So we're only focused on the part of the income statement basically where we used to put net income. And that's because this company has a discontinued operation this year. They're selling a whole component of their company, and they actually did end up selling it by the end of the year. Now, how do we report earnings per share? First, we reported on income from continuing operations. So we'll take that 425,000 divided by the 100,000 shares, 425. Then we'll report the effect on earnings per share from that discontinued operations. So we'll take the loss on discontinued operations divided by 100,000 shares. So earnings per share was decreased by $3.20 due to this discontinued operation loss. Our earnings per share on net income then is $1.05. If we just reported that $1.05, our investors will think we're only making $1.05 in earnings per share, and that's how it's going to continue into the future. But that's not true. Part of our operations, the part that really decreased earnings per share this year, was sold. It's gone away. Next year it won't be here. So that's why we list earnings per share in terms of the income from stuff that's going to continue into the future. That's 425. We do have to subtract the loss on the discontinued to show actual for the year. But this gives so much more information than just reporting $1.05. In exercise 4.7, again, the company had before tax income. Now they have before tax $1,056,000 before considering the following material items. They sold one of its operating divisions, which qualified as a separate component according to GAAP. The before tax loss on the disposal was $324,800. The division generated before tax income, and that'll happen. Not all places that you're selling are operating in a loss. Okay, from operations from the beginning of the year through the date of sale, disposal, $464,000. Neither the loss on selling it nor the income related to the division for the year is included in that $1,056,000. The company incurred restructuring costs of $75,000. The income tax rate is 25%. Now, income from continuing operations, $1,056,000. But that's before considering additional items. The company never subtracted out the restructuring cost. This is not a separate component. This should have been subtracted out in operating expenses. So what is the true before tax income from continuing operations? The difference. Now impose the 25% income tax on that, and you get income from continuing operations. So that's how you get that number. Now we'll deal with the discontinued component of it. So we start with income before tax income from continuing operations, right? Now the discontinued operations. The income from operations of a discontinued component, including the loss, is $464,000. In income, $324,800 in the loss of the disposal. So net $139,200. So you have to combine those two. What was the income from operating that component for the year until we sold it? How much of a loss or gain was there on the sale? Now subtract the income tax effect. Well, if you made $139,200 overall, you're going to have 25% income tax, which will decrease your income on discontinued operations. Since we have an overall income on discontinued operations, we add it to our continuing operations to get our net income. So just another demonstration of how discontinued operations could occur. In exercise 4.8, company has two separate operating divisions. One manufactures machinery and the other breeds and sells sheep. Both divisions are considered separate components for GAAP. The sheep division has been unprofitable. October 15th, they adopted a formal plan to sell the division. The sale was completed the following year. What will be the how will the components at December 31st, the component was considered held for sale. On December 31st, year one, the company's fiscal year end, the book value of the assets of the sheep division was $30,000. On that date, the fair value less cost to sell was $24,000. The before tax loss from operations of the division for year one was $12,000. The company's effective interest rate is 30%. The after-tax income from continuing operations for year one was $42,000. So let's prepare a partial income statement for year one, beginning with income from continuing operations. And then we'll do it again, assuming a different fair value on the sheep division. So, loss on discontinued operations. So the actual loss on operations was $12,000 for the year from January 1 through December 31st. They told us that. There's an impairment loss on this company because the cost of it, or the basis, is $30,000. The fair value is $24,000. So that difference, although we didn't sell it yet, it should be recorded as a loss because the fair value is less than the book value or cost. So the total loss on discontinued operation before tax is $18,000. 30% tax savings because you have a loss here. So the actual loss would only be $12,600. So income from continuing operations was the $42,000. Report the discontinued operations loss to get overall net income of $29,400. So if you have a division up for sale and its fair value is less than the current cost on your books, the difference is reported as a loss now. But watch what happens when the opposite is true. In part 2, they said, now assume the division's assets are worth $42,000. When you're calculating your loss on discontinued operation, you just report the loss from the operation. You don't report any gain because the value is higher than the cost. Okay, and that's the conservative principle. The loss, yes. If it's a gain situation, no. So the loss on operations is $12,000. 30% of that will cause you to have an income tax savings of $3,600. So since you're saving $3,600 in taxes, the actual loss on discontinued operations is $8,400. Start with your income from continued operations, $42,000. Then subtract the $8,400 that we just calculated to get net income of $33,600. Now next year, if they sell the division, that's when they'll report the loss on disposal or gain on disposal. In 410, The Enmark Import Corporation had 1.14 million shares of common stock outstanding during the year. Its income statement reported the following: income from continuing operations, discontinued operations, and we need to prepare the year one earnings per share, just that part of the income statement for this import company. So, income from continuing operations 4.78 million, loss from discontinued operations 1.39, net income 3.39. Earnings per share then would be the 4.78 million divided by the 1.14 million. So, $4.19. Income from discontinued operations would be the 1.39 divided by 1.14, or an overall effect of decreasing earnings per share $1.22. Net income would be the 3.39 divided by 1.14 million shares. So overall earnings per share on all income is 2.97, but the earnings per share on continuing operations 4.19. Okay, moving on. That was all our income statement. Let's go to statement of cash flows. So the accounting records of Silverwood Company provided the data below. Prepare a reconciliation of net income, which is an accrual way of measuring activity, to net cash flows, which is a cash method of measuring operating activities. Using the indirect method, we start with our statement of cash flow. Remember, starts with cash flows from operating activities. We always start with net income, and we're actually going to convert net income accrual to net income cash. The first thing we do is add any non-cash items on our income statement, which would be depreciation expense. Depreciation expense has no cash element in that expense amount. Then we will report the major changes. I don't think there's any change due to non-cash revenue. So now we will report the changes in operating assets and liabilities, because they are part of this conversion of net income to net cash flow. The first we'll deal with are add decreases in assets, increases you subtract. For instance, increase in accounts receivable. Well, if accounts receivables increase, that means we got less cash from sales. So overall, that's a decrease to cash flow. If inventory decreases, that means we spent more on inventory. So that's a decrease to cash. I'm sorry. If inventory decreases, that means we spent less cash on inventory. So that's a increase to cash flow. If prepaid insurance decreased, we paid less in prepaid insurance, so that increases cash flow. So whenever a current asset changes in one direction, the effect on cash flow is the opposite. Now we go to current liabilities. If a current liability decreases, so does cash, because that means you paid more in cash on that current liability. And if it increases cash. So it has the same effect on cash flow. So the change in current assets is an opposite effect. The change in current liabilities is the same effect. And this is all about converting net income to net cash from operating activities. And all these activities accomplish that. So we add and subtract all those items together. So if we purely reported cash only in our journal, our net income would have been $28,300 this year. That's what that's saying. This is the indirect method, the most commonly used by accountants, but hated by GAAP. GAAP wants us to use the direct method. but it's easier for us to complete a statement of cash flow using this method than it is the direct method. Exercise 420, we're going to go to next. Again, presented below is the income statement and comparative balance sheet information for Langard Enterprises. We are going to create a statement of cash flow from it, from operating activities. Well, first we're going to do operating activities. So remember, this is a formal financial statement. It's not probably stressed enough in our early classes of accounting, but that's because we need to know a lot about accounting. So if you don't understand this, you need to get it down, and you address it again later in your intermediate accounting experience. Statement of cash flows for the year ended. We're showing how cash changes from activities, major business activities. First one being operating, which is most of our activity, but the other are investing, purchasing and selling long-term assets, and financing, paying and acquiring debt and equity. So let's start with cash flows from operating activities. We always start with net income. We look to see, are there any non-cash expenses or income items on our income statement? And the only one there is depreciation. Add it back. We add it back because it wouldn't have been subtracted if we reported our income statement from a cash perspective. Now let's look at the change in each current asset. So accounts, except for cash, because that's what we're proving here, how cash changed from 240 up to 494. So accounts receivable, we take the difference. It looks like it decreased in accounts receivable. So if accounts receivable decreases, that means we received more cash. Inventory, that increased. So that means we paid out more for inventory during the year than we had at the beginning of the year. Prepaid insurance increased. It went from 24 to 60, so that means we paid more for prepaid insurance during the year, the difference. Property, plant, and equipment are not accounted for here. They are considered a finance or a investing activity. So we go to our current liabilities. Accounts payable went from 410 down to 342. We paid more on accounts payable, it decreased, so cash decreased by the difference. Payables for other expenses went from 380 down to 285. Again, that's a major decrease. That decreases cash. That means we paid on those liabilities. Income taxes increased, so we paid less in income taxes, so that increases our cash by 40. And the note payable is considered a long-term item because it is due in year 3. So we've accounted for all of the operating assets and liabilities. So we will net all those dollar amounts together to get operating cash flows, $1,033. Now we go to cash flows from investing activities, which you have to do a little calculation here. Unless they tell us, we need to know, how did property, plant, and equipment change? Well, let's see how accumulated depreciation changed. It went from 580 to 840. Okay. Now the only thing that will change accumulated depreciation normally is more. So if I took 580 plus my depreciation expense of 260, I get 840. Now what's the significance of that? The only change was adding more depreciation expense. So that means we didn't sell any property, plant, and equipment. If we did, accumulated depreciation would have decreased. So that change in property, plant, and equipment from 1760 up to 1953 is a purchase. And since there's no other information here that I could see, the assumption is the company paid cash for that $193,000 in property, plant, and equipment. So that's a decrease in cash. We're not saying did the equipment increase. We're saying what was the effect on cash when the equipment increased? It decreased cash. So we have a net cash flow from investing activities of $193,000. The financing activities area is where we account for changes due to long-term liability change and equity change. So now we're going to deal with our note payable. Note payables went from $690 up to $920. So we must have borrowed $230,000 more. So that's a positive increase in financing activities. So cash went up due to that financing activity. Common stock, it went from 900 to 1,013. So we must have sold additional shares getting cash of 113. Now retained earnings, it went from 304, add net income, 889, subtract the 264 balance. That means we've paid out dividends of 929,000. Because the only things affecting retained earnings as far as we know is the beginning balance plus net income. If there were no dividends, that should be the balance of our retained earnings, but our balance is only 264. So the difference is a decrease in retained earnings and also an overall decrease in cash because the dividends were paid with cash. So net cash flows from financing activities, 586. We've accounted for all the changes in our accounts due to cash, involvement of cash, either cash coming in or cash going out. Overall, our net cash flow from operating is 1,033 if you want to look at it that way. We used 193 for our investing activities and we used 586 for our financing activities. We net those three numbers together. Cash increased from year 1 to year 2 by 254 according to our computations. Let's see if we're right. Cash at the beginning of year 2 was 240. Add the 254. Cash at the end of year 2, 494. It agrees to our balance sheet. So this statement is defining how cash changed from year 1 to year 2 by the major types of activities a company does in its operations. That's a full throttle cash flow statement. So please post as many and any questions you may have about any computations related to it. The problem I'm going to do is really right out of your book. So it's P47 and it is a comprehensive income statement. Looks like it's the dual variety. And this is on page 217. The following income items appeared on the adjusted trial balance of Chambry Manufacturing. It's on page 217 for the year ended December 31st. Sales revenue, $15,300. Cost of goods sold, $6,200. And you could see right from our income statement there, we're subtracting them to get gross profit of $9,100. We then have our operating expenses, selling expenses of $1,300, general and administrative of $800. Now, we would have to go on and read some more to find out what else is happening there. And it says on I'm looking to see where the restructuring is. In part 2, one of the company's factories was closed during the year. Restructuring costs incurred were $1,200. Okay, it doesn't say they got rid of a whole division. They just closed a factory. That's not a discontinued operation unless they got rid of the whole division. So we add up those expenses. Total operating expenses are $3,300. Subtract them from your gross profit to get operating income of $5,800. Now we list our other income and expense items. Interest revenue of $85 is listed. Interest expense of $180. And they go on and tell us that where is it? Investments were sold during the year at a loss of $220. So that's a loss on sales of investments. That's in part 1. So we add up those. The net effect is a negative $315, which decreases operating income. We then get income from continuing operations before taxes because in Part 3, there's a discontinued operation. We multiply the 5485 times the income tax rate of 40% given in the problem. The income tax expense is $21.94. Subtract the income tax, you have to pay that, on the 5485, you get income from continuing operations $32.91. Now, let's deal with this discontinued operation. So this is just a continuation. Income from operations of discontinued component, including the gain on disposal of $1,400. So in Part 3, they said they completed the sale of one of its divisions. The division had incurred a loss of $560 and sold the division at a gain of $1,400. So the net is an $840 gain. They'll have to pay income tax on that of 40% of $840 or $336. So the actual income from this gain is $504 after paying those taxes. Take the $504, add it to your income from continuing operations to get $37.95 net income. Now the rest of this. The unrealized gain of $320 is a gain on unrealized gain from investment. Now it's at 192 because we took the 320 times 40%. Now subtract the 320 minus 128, which is the tax. So the net of tax is 192, increase. There's another odd item, and you're not expected to know this, but if a company has a negative foreign currency translation adjustment, that means that when they were translating from the foreign currency to the United States dollar or vice versa, there's an actual loss from that translation. Okay, in this case, it's a $240 loss. 240 times 0.4%, there would be an income tax savings of $96. 240 minus 96, so the overall loss is $144. That's another item that would be reported in other comprehensive income. So the other comprehensive income items are netted together. Net, it's an overall increase of $48. Add that to your income from net income, $37.95. Your total comprehensive income, all income items, $38.43. So that's a great, great problem. If you can get through that and understand that, you'll be in great shape for this chapter. Don't forget, you need to calculate earnings per share for each major category or line item on your income statement, starting with income from continuing operations. So you would take your income from continuing operations, okay, the weighted average shares, let's make sure we understand this. They tell us that the company had 1 million shares at the beginning of the year and sold an additional 400,000 in the middle of the year. So we have to weight that as if it was there for the entire year. So 400,000 divided by 2, since it was only there for half a year, would be as if it was 200,000 for the entire year. So the weighted average common shares would be 1.2 million we would use in our denominator. So we take income from continuing operations divided by the 1.2 million gives you $2.74. Your income on discontinued operations of 504 divided by the 1.2 million gives us 42 cents. And then our net income of 3,795,000 divided by the 1.2 million weighted shares gives us $3.16. We do not compute earnings per share on comprehensive income. Okay, so that is, like I said, a great, great problem. If you have any questions on any of these items, please post them out on the discussion board.